But of course, the big focus is on still the market action following last week's abrupt pivot from the Fed towards a more aggressive rate hike path. And Goldman Sachs last night raising its recession probability from 15% to 30%. And then we heard from former U.S. Treasury Secretary Larry Summers saying the U.S. will need to have unemployment rates above 5% for 5 years to take inflation down. Yahoo Finance's Myles Udland at the desk here to talk about this. And Myles, first of all, great to have you on this side.
I was going to say, I'm not allowed to read prompter, though. Tough.
No, you're not.
Tough scene for me.
You're going to have to just actually talk off the dome now here. Try to get through it. Hey, any recession call is just a recession call, right? I mean, I guess on one hand, why should we put any more water into Larry Summers' thoughts than anyone else's? But look, This is becoming a prevailing talking point, which is that the Fed might not be able to keep unemployment rate down if it wants to try to get ahead of inflation.
Yeah, well, there's like two parts to this conversation. So we'll start with the Larry Summers part, which is like a classic Larry Summers. Unemployment could be this or that or the other. That's his argument. Could be one of three things is how we need to proceed here to sort of get inflation under control. But really what it sounds like to me is Wall Street economists in their own way all accepting what higher interest rates are likely to do. Yeah, I mean, in general, higher interest rates are going to be, in general, rising interest rates will be negative for growth, and they will be negative for corporate earnings, negative for profit margins, and negative for the economy. But it takes some time for these things to both be seen in the data, see the Fed do it, for these, recession calls to start ratcheting up. But what's a 30% recession call anyway? Kathy Woodmath actually says that's a 100% increase in the recession probability from Goldman Sachs.
That's a very mathematical approach to that. That is one view of it. But okay, so here's the thing. A lot of dunking that was, attempted by some sides of FinTwit over the weekend over Larry Summers' kind of take here. And this may be because of the fact that he had already had some attention for that third call. You remember it was a third chance of a recession, third chance of no recession, third chance of something else in the middle. I mean, how important do you think the economist view is right now? Because you brought up earlier in the morning that the markets have already come around to the view that a recession was going to happen months ago. And it's only now that you're starting to see these Wall Street notes start to say that. Why the difference?
Well, again, we'll do the two parts. Larry Summers matters because he had a call with President Biden about the economy. Yep. So the president calls Larry Summers and says, hey, Larry, what do you think about the economy? So it matters for that reason, regardless of what we think of his construction of maybe. On the Wall Street economist side, I think what you are starting to see is an acceptance, and ultimately, we talked about this last week with the SEP. The SEP, if you kind of finely read that, is saying the economy is going to slow down, if not tip into recession, and Wall Street economists are now saying, okay, we believe the Fed to an extent.
So I guess here's the question is, a recession is a recession, but the severity of the recession is not something that you can necessarily see when Goldman Sachs says, well, we're raising our odds from 15% to 30%, right? You can have a recession that looks something more like 2000, which is going to be a very different story than 08 versus 2020.
Yeah.
So is that the conversation? Is that the next evolution of this conversation?
I think it is, but that's the evolution that I do not care for. I talked about this with Julie last week because Julie Hyman was sort of being like, well, if it could be a shallow recession, right? That's not so bad. The reason, in my view, that all recessions are bad is because you don't know what happens when the economy starts to slow, when people begin to lose their jobs. Negative externalities, to use a Brian Chung framework on that one. So I think that we can now start having the conversation. Deutsche Bank, more severe but sooner, shallower but longer from other banks. If the economy is going to slow down, we don't know exactly what shape it will take, but it does seem that there is now more acceptance, let's say, of with the idea that there will be people losing their jobs, there will be fewer people employed, and as a result of that, we're going to get a recession.
No recession is good. That's a Myles Udland quote. Kind of like what
my controversial
That's
take.
What Jay Powell basically told me when I asked him, why the difference between the Main Street view and the Fed view, and he was like, no one likes inflation.
No one likes
Everyone
inflation.
Knows that.
No one likes recessions.
Yeah.
No one likes multiple dinners.
Morning brief, perhaps.
God, we have moved so far away from can't eat twice per night.
Which I think we should do a whole another column on that, actually.
That's kind of like
can't eat dinner. You can eat multiple. I can eat 3 to 4 dinners in one night.
God, there's so much there. Like, what a different world. Jay Powell talking about 2 dinners a night.
All right.
How far we've come.
Junior senior market editor Myles Udland. Thanks so much for stopping by. Appreciate it.